Get
Well, as if we don't have enough bad news for markets and macros, the consumer price inflation number for February is looking very bad. At 6.44%, it's way above the CNBC poll of 6.29%. We did have a range when we polled. We did get an outer end of 6.4, but this is above the outer end at 6.44, so it's not looking very good. Food price inflation is at 5.95% versus 6% in Jan. Remember, January inflation was largely cereals driven. But the point is here, we have seen a crash of onion and potato prices. In spite of it, food price remains at close to the 6% mark, indicating that perhaps cereals are still pretty expensive, and that may explain part of the rise in the 6.44. Okay, I can give you the details now. Cereals prices are up 16.73%. It was 16.27% if I remember right last month as well. So no let up in cereals inflation. And the other one is milk, coming in at 9.65. Last month it was 8.7. So clearly there has been a sharp rise in milk inflation, and that perhaps is taking away from whatever little we have got in terms of a vegetables disinflation. Vegetable prices have fallen by 11.61% year on year. I'm reading all year on year numbers first. So whatever vegetable disinflation taketh away, milk inflation puts back, cereals inflation not showing any signs of any let up, but that is to be expected. Now, I think this will be the cereals inflation for quite a few months now, till the Rabi harvest comes in and there is a seminal fall in prices. We are going to see this high cereals inflation number. Pulses not very bad at all at 4%. So the ugly numbers really are cereals and milk, and perhaps even fruit at 6% is not a very pleasant number for winter months. Eggs at 4.3%, again not terrible, but nothing is letting up. That's the important part. So you have a huge food and beverages inflation of 6.26 and pure food inflation at 5.95, as I told you. The services inflation is going to come in at 6%. Core CPI is actually 6.1%, unchanged from the previous month. So all the ingredients are there. Personal care and effects, where much of the petrol, the gold prices would be there. That one is up 9.4%. Transport and communication is up 4.46%. Health 6.5%. Household goods and services 7.35%. So core goods and services also pretty high at 6.1%. Short point, we don't have a let up on inflation at all. Month on month increases, housing index is up 0.8% on the month. I guess that that's perhaps an outlier, but we will toss it to the experts who are joining us now. Nikhil Gupta, Chief Economist at Motilal Oswal Financial Services. Aditi, Nayar, Chief Economist at ICRA. Lakshmi, Iyer, the CEO, Investment Advisory at Kotak Investment Advisors. Lakshmi, I'll come to you a little later after I get the economist. Rupa, Rege, Nitsure, the Chief Economist at L&T Financial. Abhishek, Upadhyay, the Senior Economist at ICRA PD. Gentlemen and ladies, thank you very much. What a shocker of a number, 6.44. Rupa, you go first.
As per your money control report only, this inflation could be higher because they have used different statistical procedure to take care of these free food grains, distributed through PDS. Because they have assigned zero weight to that, they have removed it from CPI, and then on pro rata basis, they have distributed that to other food articles. If that is the reason, then I feel this ugly print is mainly because of administrative reasons. Because the disinflation in vegetable prices is very high, and other components also are not showing that higher increase. But without people's consumption going up, if you have increased the weights to take care of, the PDS weights, then the inflation number is higher majorly because of this PDS food grain adjustment, which is very unfortunate.
But this will play out for many months now, that means?
I really don't know, but I really don't see the connection. I feel Reserve Bank of India or the MPC should look at inflation without this adjustment,
Okay, but
because
I'll
otherwise
tell
it
you,
will stay.
I take your point, Rupa, that, reducing PDS because it is free food grains to cereals to zero and distributing it to others has caused the rise in inflation. But you look at several products, milk, for instance, an index of 174.6 has become 176.2. That is an, over 1% rise over the month, milk prices. Likewise, cereals as well have gone up from 173.8 to 175.1. So forget the weight. Even in real terms, the index of cereals has gone up month on month. So let me get the others also on this. Aditi, your thoughts? 6.44, does this leave the Reserve Bank nowhere but on the way up or in terms of hiking rates?
Thanks, Lata. So setting aside any adjustment that has been done to take care of the free food part of the PDS, from last month to this month, our estimate was that the CPI inflation was only going to come down from 650 to 640, which is in line with what has come out today. So I'm not sort of taking away, I'm just letting the status quo be as far as the PDS, cereals is concerned, and not making any adjustment on my own for that. So first of all, this number is in line with what we expected. And I think all of the subcomponents are also in line with what we had penciled in. So there are no incremental negative surprises. What happened as far as the CPI, the serial adjustment last month continues. And I agree with Rupa that that's something that the RBI and the MPC need to delve into and really look at what has happened and what is the impact of this change. And if we strip it away, where does that leave the CPI numbers? As of now, with two CPI prints, which are so far above 6%, I don't think there is any option but to go in for another rate hike, unless the MPC is able to ascertain that this is a specific impact related to this statistical adjustment and therefore it can be looked through. However, if there is a rate hike, I do expect it to be non-unanimous. And looking ahead, because of the base effect as well as the steps taken by the government to arrest cereal prices, I do think that the CPI inflation should come down to about 6% in the current month. And then the Q1 average, thanks to the base effect, should be maybe around 5.4%. But right now, the optics look pretty bad before the MPC.
Oh, absolutely. Unless the current month inflation comes at 5%, there is no way the quarterly inflation is going below 6%, which is the MPC's Lakshmi Rekha. So they are going into the press conference with the realization that they are violating the given mandate. Is one way of looking at it. Though, of course, they could give growth a higher weightage, as some members have chosen to. Abhishek, I think, the numbers are bang on with what I got from you. In terms of milk, at least, I think you told me you were expecting 9.7 or thereabouts. So your overall comment on 6.44, it's still higher than what you thought, right?
Oh, it's more or less in line. Even core inflation, we expected 6.1%, and it looks to be around that same ballpark. Food inflation, was the key issue besides core. And within food, it appears cereals inflation has gone up by about 0.8%, 0.9%. That is still a reasonably strong increase, of course, lower compared to the 2.6% increase you got the previous month. But this is still a strong increase. And as you mentioned, it is not just cereals. Milk inflation is also up 0.9% month on month, seems to have picked up from the previous month. So the issue is, even within food, the major subgroups continue to see reasonably strong gains. And this will be a concern for RBI that still there are no clear signs of disinflation. This number by itself, our next March print, based on the high-frequency indicators, high-frequency data for food prices particularly, is tracking lower. There is good news there. Cereals prices seem to be finally coming off. The next print could be 5.6, 5.7%. And if that is the case, then the current quarter inflation is tracking about 50 basis points higher than RBI forecast still. So, yeah, overall a bad print, but monetary policy decision in April will also have a strong weight from what is happening globally. And if you see, market has actually priced out rate hike in April because of recent global development. So what happens on that front need close monitoring as well.
Oh, absolutely, absolutely. We have the US CPI numbers coming on Tuesday evening, our time, and then you will have the FOMC decision on March 22nd. So while this is the last inflation number for the MPC, there are a whole host of other developments for the RBI as distinct from the MPC, which will go into decision-making for sure. Nikhil, Gupta, final comments from you on the inflation number itself. We will come to the rate hike in just a bit. But your thoughts, will you now start reworking your FY24 inflation numbers as well? Is RBI's 5.3 forecast for next year under threat?
Hi, Lata. Thank you very much. So, Lata, we were also at 6.4%.
Oh, okay.
I don't think I was included in your CNBC poll,
Okay.
but our headline number was also 6.4, and core inflation, we were expecting it to be the same as it was in the previous month. Food inflation was also expected 6%. So there is no such surprise for us as far as February inflation is concerned. But we do expect that inflation will be slightly below 6% in March, and it will continue to decelerate from there on. So no surprises. Core inflation and headline inflation broadly in line with expectations. And I just want to mention one point on serious inflation, Lata. We know that since it was given free of cost to the consumer, so the weight has been reduced to zero. But we also need to understand that since the PM Garib Kalyan Ann Yojana was discontinued, so consumers or citizens who were getting free food earlier, extra free food close to 5 to 6 kgs per month, they will have to go and buy that amount of wheat or rice at the market price now. So the cost for them has actually gone up, which is what is reflected, and which is one of the key reasons why the CSO does what they have done or what they usually do. So I think this is rational, and it reflects what is actually happening somewhere on the ground, rather than keeping it as a pure Excel exercise.
Okay, yeah, you know, actually
so
that was what I was guessing when I saw the Jan number, that perhaps cereals inflation has been marked higher because a quantum of market prices of cereals has been included, since only 5 kilos is available free, and that may not be enough in terms of calorie count. But for whatever reason, for a different reason, the NSO has marked inflation higher. But as you see, it is biting. The cereals inflation is biting, and while potato and onion disinflation in particular is removing some of the sting, a large part of the protein inflation in the form of milk is going to continue. In fact, we had Ajay Veer Jakar and Ramesh Chand on the channel recently, along with Harish Damodaran, all of them referring to a huge fodder shortage, which they believe will continue to keep an upward pressure on milk prices. This may not be the last of the milk inflation. We are going to see perhaps higher prices, was their guess, as we get into the summer months. Okay, and now we have to come to what action can be. And Lakshmi, you lead the way for us. Would it be, I am not going to vote at all on the rate hike front till I see what the FOMC does, or would you want to take a jab at what RBI will do?
I think, Lata, more than the inflation number today, which I think most of the panelists have opined, it has come in broadly in line with expectation. I think markets are not really going to get disturbed by this number for sure. The bigger narrative obviously is going to be how much more the global impact is going to be much more felt. You're already seeing the 10-year benchmark at under 3.55%. I don't even want to head into that territory where Fed Fund futures are talking about a 0.5% rate cut before the end of this year. So I think incrementally, and as we speak right now, some of the regional banks in the US are trading 30 to 50% lower. So there is a fear of this contagion. Gold at $1,900. Nothing of this can be completely, sidelined. So I think it is going to be a tough ask from the Reserve Bank. But if the Fed acts, and do a 25 basis rate hike, I don't think there is anything stopping the Reserve Bank of India also from hiking 25 basis points when they meet on April 6th.
Okay. No, point taken. 6.44 is still above. I don't think this is in line with street. I think the street was at 6.3. It just happens that three of our experts were closer to 6.4, but our average clearly was 6.3, and that of many other news agencies as well. So it is a slightly higher than expected kind of inflation number. But I take your point, there are other things on the Reserve Bank's mind. Now, let me make the argument stand on its head. Rupa, if what Lakshmi says is right, and there is, a global consternation, all the more reason why Reserve Bank will have to protect currency, isn't it? We have not yet seen an attack on the currency because we are on a fine fettle in current account terms. But the current account is still a gap, and it has to be financed. So if there is money leaving out in droves, will that actually force the hand of a rate hike?
Well, Reserve Bank has been saying it again and again repetitively that now they have formally adopted inflation targeting framework. So, foreign exchange management is not part of the monetary policy decision making. What they actually do to control contagion depends on various, factors influencing the currency situation at a point of time.
Yes.
But certainly that will not be a major part of their decision-making process. But definitely, Fed's actions, because partly, as you had rightly said, that they have to follow their mandate for inflation targets, and for whatever reason we are seeing this ugly print. They will certainly, the 25 bips rate hike is given. But you see, before this SVB crisis and the way US yields have taken a U-turn, everybody was expecting Reserve Bank of India to even go for a 50 bips hike.
Okay.
So now with this global situation, it will not be very aggressive. But given the last two prints, I think 25 bips hike is given. But, this external situation has just reduced the possibility for 50 bips hike.
Fair point. Abhishek, actually, I want you to react to the fact that, at such a time, the external situation will prey on the RBI's mind, even if not on the external members of the MPC, right? And secondly, the IIP indicated that industrial growth is reasonable. In fact, it was better than our poll. So even in terms of growth, there is less to crib. And perhaps something to speak about aggregate demand also pushing up prices. What do you think, RBI? Do you think that argument will move RBI's hand towards a hike?
So purely domestic factors, if you see either inflation, you need to see a substantial softening, or on the growth front, you need to see abrupt weakness for RBI to ideally shift tunes. And you have not seen any of that, of course. But now, there's still some time to the policy meeting, and given the kind of risks we are seeing emerge globally, if we do get indication that globally growth will be so bad heading into the next few months that there will be sharp downside risk to growth, unless you see that kind of a scenario, think the probability of another rate hike still is reasonably good. Our baseline view is Fed will hike 25 basis points, potentially even add one more rate hike to the dot plot, although that is now quite far from what the market is currently pricing. So we have to see how these contagion risks, etc., which are being monitored now, evolve over the next 7-10 days heading into the FOMC meeting. But the baseline view is 25 basis point rate hike. Likely from RBI.
Okay, so that's three of you saying 25 basis point. In fact, Rupa is even more emphatic, saying that it is almost a given, and perhaps only a 50 is taken off. I just want to speak again about Fed fund futures and what the market is expecting from the Fed. It's impossible to guess, what it might do even like 1 hour down the line. On Friday night, when SVB was still hot, before the SVB crisis became very hot, Friday morning, our time, the bets on a 50 basis hike from the Fed stood at 75% on the CME Fed Watch tool. Monday morning, it came down to 0 for 50 basis point, and 97% were expecting a a 25 basis hike. And right now, before I started, when I checked, there was a good 25% again expecting a 50 basis hike because it looked like the FDIC and the Treasury have moved in very strongly. So market expectation is changing by the hour at this point in time as far as the Fed's moves are concerned. And I guess we will not know much till March 22nd. Quickly again, what's ICRA's view, Aditi? On RBI, I mean.
So, Lata, yeah, there's definitely a lot more that's going to come our way in the next few weeks. As of now, based on the optics of 2 6% plus prints, I expect a non-unanimous decision of a 25 basis points rate hike. I would prefer a pause looking ahead at the fact that inflation is expected to cool later on in the year and that second half GDP growth isn't really going to be very high. And looking at the external risk to growth. But given the optics of the 6% inflation, I guess it's going to be another rate hike.
And last word from you, Nitin. Nikhil.
Yes, Lata. So I don't have any doubts. The Fed and the RBI both will be rising by 25 bips in their next policy. In fact, Fed could go ahead and hike by another 25 bips in April. June will be, I guess, much more trickier than what we can anticipate at this point in time. But RBI's April, I think, is almost given, and same is the case with the US Fed.
Okay. So here the majority quite clearly expecting the Reserve Bank to bat for another rate hike, and the Fed as well, 25, not 50. But there is a constituency for 50 even for the Fed. We heard very strongly from Citi and Nomura earlier today. And even Morgan Stanley kept its options open from the US, saying that it is 25 as of now. But if tomorrow's inflation print, core inflation prints higher than, 0.4 month-on-month core inflation, then they are looking at a 50 bips hike from the Fed. There is a large constituency which believes that the US banking sector is fundamentally healthy, that cases like SVB are idiosyncratic, and therefore banking stability will only marginally dwell on the Fed, and inflation, the nature of the jobs data and labor data will be predominant, as of course the CPI number that comes tomorrow. Thank you very much for joining me in this special discussion on the state of the economy. The key takeaway, inflation number is a little worse than our poll expected. The number coming in at 6.44 for February is making it very clear that for the quarter Jan, Feb, March, the inflation number is going to be above 6%, which is above the given mandate to the MPC, which is to keep inflation below the 6% mark. So chances of a rate hike are very high, according to our panel at least. But of course, everyone's keeping their options open, depending on the global developments. That's it on this special edition of the State of the Economy. Keep it with CNBC-TV18. Lots of important news and views are about to follow after this break.